the Irish balance sheet Mirage. It looked solid, orderly, almost reassuring at first glance. Rows of numbers aligned perfectly, capital ratios appeared healthy, and balance sheets projected confidence at scale. But like a horizon that shifts as you approach it, Ireland's financial strength was hiding something deceptive beneath its surface. To understand how Ireland's balance sheets became a mirage rather than a mirror, we have to return to a moment when growth felt unstoppable. Capital flowed freely into the country, drawn by opportunity, innovation, and a banking system praised for its modernity. Institutions expanded rapidly, funding development, property, and ambition with remarkable speed. On paper, everything added up. In reality, assumptions were doing more work than assets. The story begins inside banks that believed diversification alone guaranteed safety. Loans were spread across sectors, regions, and borrowers. Risk models showed resilience. Stress scenarios passed comfortably. As long as prices continued rising and refinancing remained easy, the system appeared robust. Balance sheets grew larger, not heavier, or so it seemed. But subtle distortions were forming. Asset values depended increasingly on expectations rather than cash flow. Long-term risks were discounted aggressively. Liabilities were structured to roll forward smoothly, relying on continued market access that few imagined could vanish. The balance sheets were not falsified. They were optimistic. And optimism, when repeated often enough, can resemble certainty. Early warnings surfaced quietly. Analysts noted that capital buffers were thinner once adjusted for concentration. Regulators questioned valuation methods that leaned heavily on recent trends. Some bankers sensed discomfort but reassured themselves that Ireland's integration into global finance offered protection. After all, international confidence was strong, and confidence, once established, has a way of silencing doubt. The Mirage held because no single number appeared wrong. It was the relationships between numbers that mattered, and those relationships were stretching. Assets grew faster than resilience. Leverage hid behind complexity. What looked like strength from a distance depended entirely on conditions staying favorable. As the system expanded, belief replaced verification. Balance sheets became statements of faith rather than instruments of control. And beneath their clean symmetry, a vulnerability was forming, one that would only reveal itself when the market stopped cooperating. That moment was approaching, and when it arrived, Ireland would discover that a balance sheet can appear strong long after its foundation has begun to shift. The illusion persisted because every mechanism reinforced it. Rising property prices validated earlier valuations. Refinancing closed the gaps between cash flow and obligation. International lenders, comforted by Ireland's apparent discipline, supplied funding without demanding deeper scrutiny. The balance sheets reflected this confidence, smoothing volatility into stability and risk into expectation. Inside the banks, models grew more elegant and less cautious. Historical downturns were discounted as outdated. Correlations were assumed to remain low. Stress tests relied on scenarios that bent but never broke the system. Each successful quarter confirmed the framework. Doubt became irrational. Prudence became hesitation. Yet, beneath the models, dependence deepened. Short-term funding supported long-term assets. Liquidity relied on continuous rollover rather than intrinsic strength. Exposure to property concentrated quietly, masked by geographic spread and layered financing structures. What looked diversified on paper behaved as one trade beneath the surface. Regulators began to feel the tension. Reports showed rapid asset growth outpacing internal controls. Valuation assumptions leaned heavily on momentum. Capital ratios held, but only under conditions that assumed markets would always reopen. Concerns were raised, softened, then postponed. Intervention felt unnecessary, while numbers remained compliant. External observers noticed subtle shifts. Credit spreads narrowed too far. Returns appeared too smooth. Balance sheets across institutions began to resemble one another, reacting to the same incentives and risks. Uniformity replaced independence, and uniformity, in finance, is rarely strength. As global conditions shifted, the Mirage became harder to maintain. Funding markets tightened slightly. Asset prices hesitated. Nothing dramatic, nothing headline-worthy. but enough to test assumptions that had never been stressed simultaneously. When refinancing costs edged upward, margins compressed instantly. The system absorbed a change, but only by leaning harder on the same structures that had created the vulnerability. Inside Treasury departments, contingency plans were reviewed and quietly shelved. The expectation remained that markets would normalize, as they always had. Confidence endured not because risks were understood, but because they had not yet demanded payment. The balance sheets still looked strong. But strength built on continuity cannot survive interruption. And as the global environment continued to shift, the gap between appearance and reality widened, setting the stage for a reckoning that balance sheets alone could no longer disguise. The reckoning began when continuity finally broke. A routine refinancing window failed to reopen on expected terms, and the adjustment rippled instantly through Ireland's banking system. What had been a marginal increase in funding costs became a structural problem overnight. Liquidity that once flowed automatically now demanded justification, and balance sheets built on rollover assumptions began to strain. Inside the banks, Treasury teams reacted first. Funding gaps appeared where models had projected smooth transitions. Asset sales are considered, then delayed, then forced. Prices did not collapse immediately, but they slipped just enough to challenge valuations that had never been questioned. What looked like surplus capital evaporated when marked against reality rather than optimism. As pressure mounted, correlation surged. Property exposures across institutions moved together. Guarantees linked banks in ways no single ledger had captured. Losses that were supposed to remain isolated spread rapidly through shared funding channels. The Mirage dissolved not with a crash, but with a realization. The balance sheets were all reflecting the same bet. Markets responded with speed and precision. Wholesale funding withdrew. Confidence reversed direction. The same international lenders who once supplied endless liquidity now demanded clarity that could not be provided quickly. Capital ratios deteriorated faster than projections allowed. The system had not miscalculated a risk. It had misjudged dependence. Regulators stepped in as reality replaced narrative. Emergency assessments revealed exposures far larger than previously disclosed, not because they were hidden, but because they had been normalized. Asset quality deteriorated in unison. Stress tests that once passed comfortably now failed under conditions that no longer felt extreme. Public trust collapsed alongside market access. Citizens watched institutions once described as modern and resilient struggle to explain positions that no longer made sense. What had been framed as prudent expansion now appeared as collective overconfidence. The balance sheet, once a symbol of control, became evidence of misalignment between perception and risk. As the state prepared to intervene, one truth dominated every discussion. The problem was not leverage alone. It was a mirage itself. The belief that clean numbers guaranteed safety even when behavior and dependency said otherwise. Ireland had not lacked information. It had misread it. And when the mirage vanished, the cost was no longer theoretical. It was immediate, systemic, and impossible to ignore. The intervention came with speed and scale few had imagined possible. The state stepped forward, guaranteeing liabilities and injecting capital into institutions whose balance sheets had collapsed under scrutiny. What had once been private optimism became public obligation. The Mirage, fully exposed, demanded resolution not through accounting, but through rescue. Audits followed with unforgiving detail. Assets were revalued conservatively. Losses crystallized. The true condition of the system emerged only after optimism was removed from the numbers. Balance sheets shrank. Capital was rebuilt through pain rather than projection. The cost was borne not by models, but by taxpayers, businesses, and households adjusting to a new reality. Ireland's recovery did not begin with growth. It began with clarity. Institutions were restructured. Governance tightened. Risk was reintroduced into pricing. The banking system regained coherence not because it was expansive, but because it was credible. Trust returned slowly, grounded in discipline rather than momentum. Europe absorbed the lesson with unease. Clean balance sheets mean little if they depend on uninterrupted conditions. Risk does not disappear when it is smoothed. It waits. Ireland's experience reshaped oversight. stress testing, and the tolerance for optimistic valuation across the continent. For Ireland, the episode left a permanent imprint. Expansion was no longer synonymous with strength. Numbers were treated as constraints rather than reassurance. The balance sheet, once a mirage, became a tool again, one that reflected risk instead of disguising it. The Irish balance sheet mirage did not vanish by chance. It dissolved when reality intervened. And in its aftermath, the system learned that transparency delayed is cost multiplied. Sometimes the smallest shift in perspective becomes the beginning of a new future. The